This is Team DEFY going over our case project. Dom's going to start out here first. I just do want to make it clear that what we're talking about does not necessarily mean this is what each person did and only did. We all worked on this together, so everybody knows a little bit of everything about this, but we're just going to split it up so we can all get about 2 to 3 minutes of talking time. Dom?
Thank you, Jack. Alrighty, so right here on the left, under new machine and old machine, most of everything in here is just off the base case, besides a few things. Our depreciable basis is for the new machine is just going to be the purchase price added in with our transportation, installation, modification. New machine is going to be under makers of a 5-year class for depreciation. Moving on to the old machine, we're going to have our annual depreciation expense, which is calculated by our depreciable basis, subtracting out our salvage value, and then it's going to be divided by our the total life of it, or useful life. Yep, 15 years. Another calculation that we have in this is going to be our net working capital. Our inventories are going up by 78,000. It's going to be an outflow. Our accounts payable is going up by 68,000 or 65,000. So it's just going to be an inflow. So our change in net working capital is going to be negative 13,000 in total. Moving on to our initial outlay, it's going to be our depreciable basis and our change in net working capital. Those are already going to be negative, so everything's just going to be added up to find our total. We're also going to have the market value of the old because we're going to be selling it in times 0, and the tax effect, which is going to be positive, and an inflow because it is our book value exceeding our market value times our tax rate. All right, so after the initial outlay, we're going to move into our incremental OCF. Since we have 2 machines, new and old, it's just going to be a difference for both. And that's going to get our change in revenue, change of variable costs, change of fixed costs, and change in depreciation. Like I said, those are just differences of the new and the old machine. Added all together is going to get our EBIT times 1 minus our tax rate. Add back in our depreciation. That's going to get us to our change in operating cash flow. And then Abby's going to take over from here.
All right, so to further analyze the decision to replace the old machine with the new machine, we're going to go ahead and calculate WACC. So if we go over here to cost of capital side, we calculated the debt using our rate function right here. And then from there, we applied 1 minus the tax rate. And then for for weight of debt, we did total debt divided by total debt plus total equity. And then over here, we went ahead and used the Gordon growth model to get the cost of equity here, and then did the same thing in reverse to get total weight of equity. And then we also went ahead and ran our CAP-M calculations. And then we decided to take the average between the two to go ahead and get our cost of capital, which would be 8.5%. Now bouncing back over to our operating cash flows. Now looking at the liquidation terminal flow, we went ahead and grabbed our change in net working capital, added our sales, and then used the tax as an outflow. Then right here, you can see our sale of old, which we considered an opportunity cost. Therefore, we considered it
a sale foregone.
Mm-hmm. And then once again, incorporated the tax effect old, giving us a terminal flow of a little over $90,000. Then we went ahead and ran the timeline here and calculated our MPV. So after calculating our MPV, we decided that we should replace the old machine with the new machine. Our MPV is far above 0, and looking at the MIRR, it is greater than our cost of capital. And then moving on to our alternative machine. So we went ahead and we reran the MPV with the estimated cash flows given in the case. And we would still consider rejecting this alternate project in comparison to our base case MPV calculation. And then also in the alternative project, we went ahead and ran this as a continuation or a continuous instead of liquidation. So we assumed that the year 8 operating cash flow is going to be a combination. And then up here is where we did the annual growth of 1% from years 9 to 15. So like I said, the continuous method here, getting us our MPV, but our recommendation is still going to be accepting the original base case problem. And then we're going to be passing it on to Nima.
So third is the sensitivity analysis. It's basically almost the same as our base cases, except we're going to be growing our revenue, but sorry, not the revenue. We'll be growing our unit right here by 2.5%, and the price will inflate by 80 bips, which is basically 8% of 1%. And you just multiply those to get the revenue right here, and then we just put this back into our incremental cash flow. Same thing with the variable cost for the old and the new, and the revenue for old and the new, obviously. And right here, we put in the revenue of the old, revenue of the new, and we get the difference in between. Same for the variable cost. And then fixed cost stays the same. And the depreciation stays the same because we're not touching any of those. Here we get EBIT, same thing, just add them all together. You'll get EBIT. And we take the tax out from the EBIT and then put in the depreciation back in, and which will give us the operating cash flow for this. And right here, cumulative, we took the revenue, 18% of the current revenue. So change in revenue, this will give us 71,000, and same here for year 1, 2, 3, all the way to 8. For now incremental, we decided to incremental. We added our change in net working capital with the cumulative net working capital, and then we put that as a outflow. And same here. This from here onward is a difference between those two. You have to add the operating cash flow with the incremental to get the total cash flow for year 1 to 8. And same thing here. For the liquidation terminal flow, we have the change in net working capital of 13,000, sale of the new and the sale of the old, and that will give you our terminal flow of 77,000.
Well, I think actually in the terminal flow, we did not include the net working capital in the calculation. The reason why this was done was because we already accounted for it in our incremental. So we just took it out of our liquidation as well.
We didn't want to double count.
Right.
We didn't want to double count.
Thanks, Dominic. I forgot about that part. Same thing. Same here, WAC. We just grabbed our previous base case WAC, and then ran the number through it, and then got our NPV to be greater than 0. So we should replace the old machine with the new machine. And basically same numbers for IR and MIR, 15%. I'm going to pass it on to Jack for security market line.
All right, Jack here. Going to talk about the security market line along with the bank questions. So I went ahead and I hand drew this, Dr. Newman. I hope you can appreciate this because this was difficult.
Very pretty.
But we got our our rate stated as a percentage up there on the y-axis. Down on the x-axis, we got our beta. I'll go through just A through E here. Our A was going to be our risk-free rate at 1.09. That's going to be well below the rate of the market at 7.09. You can see though that 7.09 is going to match with a beta of 1, which is just because that rate of the market is going to follow the beta of 1. Going over to D is going to be our firm's beta at 1.82. So that's going to be a little farther aligned on that beta axis. That's going to go up top and match with our WAC, which is our rate of return at 12.01. And in F, we got our IRR is 22%. So we are going to be well above that 12.01 region, still with that same 1.82 beta. That's going to be in our accept region, which is colored in green. So we are going to earn more than what we need at that 12.01. So for the bank questions, 411 was the economic break even. I ran a goal seek here, just setting the NPV equal to 0 by changing our revenue numbers. So our variable cost, our fixed cost, depreciation, all that stuff is just going to be pulled from our OCF in our base case. Find EBIT, 1 minus the tax rate along with depreciation. We're going to go ahead and find the operating cash flow, which I then ran an NPV for. After I ran that NPV, I went ahead and I did that goal seek, like I said, and I set that NPV equal to 0 by changing the revenue number, getting us an economic break even of 667,995.66. Coming on over to our bank question 1.2. We expected our economic break even to be greater than our accounting break even because the accounting break even solely covers what is needed for operational expenses, while the economic break even covers all costs / expenses. For this reason, we would expect our economic break even to be higher in order to account for all of these excess costs. Swinging on down to the accounting break even, went ahead and same thing with our initial outlay, variable cost, fixed cost, except for depreciation. We needed a stable year after year annual depreciation expense. So we went ahead and did the depreciation expense by assuming that we would run a straight line depreciation to a salvage value of 0. After getting that calculation, it's going to be 123,125. So that will be our annual consistent depreciation expense. Same WACC along with the same tax rate. Price per unit and cost per unit were also given, so I pulled those numbers over. So from there on out, we went ahead and did the depreciation less the fixed cost, and then divided that by the difference in the price per unit, per cost of unit. That was just to get the marginal profit in the denominator, which is for every dollar in sales, we're going to go ahead and divide that by the percent variable cost. Again, that percent variable cost is going to be replicated by that $8 divided by 275. Once we got that number at 52,104, and then 3/4 of 1 unit. To find a revenue, we went ahead and did the accounting break even, which was the unit numbers, multiplied them by the price per unit to get a consistent $416,838.10 for revenue. And over here, this is just our check to make sure that EBIT is equal to 0. The other numbers are pretty straightforward.